Beginning of a 10% correction.
10% corrections do happen on average every 18 months. And what we're seeing is just horrible market breadth.
I think the weak breadth is a reaction to the strength in dollar and yields.
The market is at risk of a 10% correction in January. Breadth is fading, macro is misbehaving as a symptom of a less dovish Fed, higher rates, and a stronger dollar. This means less supportive financial conditions for already fragile industries, and earnings growth estimates have gotten worse.
I think the next 6 to 8 weeks could be rough. It's not going to be fun.
The market is still holding the uptrend, making higher highs and higher lows, but underneath the hood, the uptrend is weakening. The percent of stocks trading above the 200 daily moving average has fallen below 60%. And the last time we saw this level of decline, the S&P had a 10% correction that started in August and bottomed in October of 2023. We can see market breadth decline to the same levels we see today. The S&P pulled back, supported the trend, but as soon as rates began to reaccelerate, breaking the previous level, market breadth collapsed along with the overall index. And the market didn't bottom until rates peaked around 5%. But if we look a little deeper, we can see that rates were just tracking the bump up in CPI, inflation. And as soon as CPI confirmed the bump up was over, rates peaked, breadth returned, and the market recovered. But the next CPI report isn't until January 15th, which means the market has to wait for more visibility on inflation. Until then, the upward pressure of rates is likely to prolong the correction.
The hope for the bulls is that washout in breadth that we saw in December is an opportunity, and we can see breadth rebound. We're certainly seeing it today, but I think for that rally and the breadth broadening to have any sustainability, you really need to see rates and the dollar not only probably pause, but really pull back lower, and we just haven't seen any signs of that to this point.